Hi, good morning. Yes, it's a very good point. Um, they've certainly learnt the lessons of the last few years in terms of the communications to the markets, kind of in the run up to these meetings. The fact that they're having these meetings every month, I think, is a very good sign. What it's demonstrating is that they're really looking at the kind of the fundamentals of the market and the data that's out there, as opposed to being driven more by the kind of the political machinations, as it were. Um, we are seeing a kind of a good level of compliance across many countries to kind of to maintain these cuts. Um, but despite the messages from the meeting yesterday, we have still seen through February a significant increase in these exports. So there definitely is this real willingness to kind of to drive the market and to kind of determine the outcome of a price, despite the fact that there aren't the very clear stipulations that there is no interest in price. Obviously, the side effect is these big moves. I think it's a very sensible kind of strategy at the moment. As I say, the data is quite mixed, and this is what all of the members are looking at. Is yes, we have drawn a lot of inventory through the second half of last year, but that's slowing down now, and that's slowing down even at a time when, say, the US supply has been reduced. So yes, big increase in inventories this week in the US, but their production is still a lot lower than it was kind of going into the freeze. So I think we are going to continue to see these kind of monthly events where they are wanting to have more of a control on the market, basically.
To what extent do you think their decision making is just a function of the shale producers in the US being more restrained than usual right now?
Yeah, it's a very good point. I think the shale producers are basically, and the companies in the US have a very different strategy now, and that's been kind of stated quite clearly over the last week or so, that there is this move away from just drilling for production, but actually they have to be far more cash conscious, and that's been essentially put upon them by the market, by the investors, by the banks. And in response to that, there is this expectation that they will be much more constrained this year. Yes, we should still be seeing some increases in production from the US, but far less than we would have expected in a kind of prior scenario with prices up at this level, basically.
Do you think that there's a risk that OPEC Plus actually over-tightens the oil market this year, given their new strategy? It's what seems to be their new strategy.
Yeah, it's a very real concern. It works for now because of the uncertainties around the demand situation. And so we're still in a very restricted environment in Europe. Things are opening up in the US, are opening up in the East. But will we see a big kind of driving season, holiday season in the summer? It's likely to come, but the timing is uncertain. So if they aren't kind of prepared to loosen the taps in a gradual way as we move through the summer, then yes, I think you're right. We could see a real tightening into the second half. But as I say, let's not forget that we did still see an increase of just under 1 million barrels a day of exports in February from OPEC Plus, with a lot of countries exporting kind of an additional 200 kind of 340 odd KBD for some countries month on month versus January. So I think no matter what's going to be happening from being stated at these meetings, it's highly likely that with crude prices where they are, we're going to see kind of this gradual drip feed of additional barrels, which isn't necessarily, as you say, a bad thing, because the risk is that they actually have over tightened going into a high demand season.